Today, we will talk about how to turn $100 into $10,000 with crypto. Realistic plan. Cryptocurrency has created many opportunities for life-changing financial growth. While turning $100 into $10,000 may seem unrealistic at first, the right strategy, patience, and risk management can make it possible. Many investors have transformed small amounts into significant wealth through careful planning and disciplined execution. However, success in crypto requires understanding market cycles, using proven strategies, and avoiding common pitfalls. This guide provides a realistic approach to growing a small crypto investment into a substantial portfolio. While no investment strategy is guaranteed, following this structured plan can maximize the chances of success. 1. Choosing the right strategy. Before investing, it is crucial to decide on a strategy. Investors typically choose between long-term holding, hodling, and active trading. Hodling involves buying and holding promising cryptocurrencies for several years, allowing for potential long-term growth. This method is best suited for those who do not want to spend time actively managing their portfolio. It reduces exposure to short-term market volatility and benefits from the overall growth of the crypto industry. Active trading, on the other hand, involves buying and selling assets frequently to take advantage of short-term price movements. While this method has the potential for faster gains, it also carries higher risks and requires experience in reading market trends. Many traders lose money due to emotional decision-making and lack of proper risk management. A hybrid approach, combining both long-term holding and occasional trading, can offer a balanced path to growing a portfolio efficiently. 2. Smart diversification of your $100 investment. With only $100 to start, diversification is essential to balance risk and reward. A well-structured portfolio includes a mix of established cryptocurrencies, high-growth altcoins, and speculative assets with high potential returns. A portion of the investment should be allocated to blue-chip cryptocurrencies like Bitcoin and Ethereum. These assets provide stability and long-term growth potential, as they have strong market dominance and wide adoption. While they may not offer 100x returns quickly, they serve as a solid foundation for any crypto portfolio. The next part of the portfolio should be dedicated to promising altcoins with high growth potential. These include mid-cap projects with innovative technology, strong development teams, and active communities. Altcoins like Solana, Polygon, Avalanche, and Polkadot have historically outperformed Bitcoin in bull markets, making them attractive options for high returns. However, they also come with increased volatility and risk. A small percentage of the portfolio can be allocated to high-risk, high-reward opportunities, such as newly launched tokens or low-cap gems. These projects carry significant risk but have the potential for massive price increases if they gain traction. Conducting thorough research on their technology, use cases, and team before investing is crucial to avoid scams or failed projects. 3. Utilizing passive income strategies. In addition to price appreciation, earning passive income through crypto can accelerate portfolio growth. Staking, yield farming, and lending platforms provide opportunities to generate consistent returns on existing assets. Many blockchain networks, such as Ethereum, Cardano, and Polkadot, offer staking rewards, allowing investors to earn interest by holding and securing the network. Staking provides a low-risk way to increase holdings over time without additional investment. Decentralized finance, DeFi platforms offer yield farming and lending opportunities, where users can earn interest by providing liquidity or lending their assets. While these methods can generate significant returns, they also carry risks such as impermanent loss and smart contract vulnerabilities. Selecting reputable platforms and understanding the risks involved is essential. 4. Timing the market and taking advantage of cycles. The cryptocurrency market moves in cycles, with alternating periods of bull and bear markets. Understanding these cycles and making investment decisions accordingly can significantly impact long-term profitability. During bear markets, prices are low and assets are undervalued. This is the best time to accumulate strong projects before the next bull run. Many investors make the mistake of buying during peak hype and panic selling when the market crashes. A disciplined approach involves accumulating assets when prices are low and taking profits during bull markets. Setting profit-taking strategies is essential to avoid missing out on gains. Rather than holding indefinitely, selling a portion of holdings at significant price increases can secure profits and allow for reinvestment in new opportunities. 5. Using free crypto opportunities to increase capital. For those starting with limited funds, taking advantage of free crypto opportunities can provide additional capital to invest. Airdrops, faucets, and play-to-earn games offer ways to earn crypto without upfront investment. Many blockchain projects distribute airdrops, rewarding users for completing simple tasks or holding certain tokens. Websites like Airdrop Alert and CoinMarketCap airdrops frequently list new opportunities. While not all airdrops are valuable, some have provided significant returns in the past. Play-to-earn, P2E, games, and move-to-earn apps allow users to earn crypto by engaging in gaming or physical activities. Platforms like Axie Infinity, Stepman, and The Sandbox have rewarded players with valuable tokens that can be sold or reinvested. By accumulating free crypto and reinvesting it into promising projects, small investors can gradually build their portfolio without additional capital. 6. Learning trading basics to multiply gains. While long-term holding is a safe strategy, learning basic trading techniques can enhance portfolio growth. Crypto trading involves buying and selling assets based on market trends, and mastering it requires knowledge, practice, and emotional discipline. Swing trading and breakout trading are common strategies that allow traders to capitalize on price movements without the high risk of day trading. Using indicators like moving averages, RSI, and support resistance levels helps traders make informed decisions. Paper trading, simulated trading without real money, can be useful for beginners to practice strategies before risking actual funds. Many platforms, like TradingView and Binance, offer demo accounts for learning purposes. While trading can be profitable, it should only be attempted with a portion of the portfolio. The majority of funds should remain in long-term investments to reduce risk exposure. What do you think of our video? Let me know in the comment section below. Also, subscribe to our channel before you go. Thanks for watching.